Hi, everyone. I'm Tomio. I'm a reporter with Wall Street Journal, WSJ Pro. I cover startups and venture capital and blockchain increasingly today. And we have a great panel here today, so I'm excited to get started. I'll let the panelists introduce themselves. We have a really great panel here. But I wanted to just start off by asking the panel just to kind of set us where we are now in the market. Last year was crazy with crypto, as we all know. This year's maybe a little bit less crazy, but still crazy. ICOs are not, are now not as in as they were last year, but there's still a lot of really big deals being done in the crypto sector. So can you say a little bit about what you're seeing in the market and the types of deals you're looking at and types of deals you're doing in terms of the amount of dollars going in, the size of the rounds, the valuations, if there are valuations, and kind of how does the market feel to you? Does it feel like it's rational, somewhat rational, totally insane? Boris, do you want to start?
Yeah, so my name is Boris Wertz. I run Version 1 Ventures. We're a $45 million early stage fund. Started investing in crypto in fall 2016. Notable investments include Coinbase and CryptoKitties. I think for me, 2017 was like the crazy year where everybody thought like blockchain is coming rapidly. I think there were a few truths that everybody believed, like fat protocols and ICO is going to take over the fundraising world. I think 2018 has shown there's tremendous amount of long-term promise, but the technology is way behind what we thought, and I think we just have to grow into where the technology is, and that will take a couple of years. I think public market valuations of major cryptocurrencies have already adjusted to that insecurity and that delay. I think private market valuations are still sky high, and there's very big rounds raised right now. So we feel we're long-term and perhaps medium-term bulls, and think short-term we'll just go through a little bit of pain. Mm-hmm.
Okay.
Hi, my name is Cheung, and I'm a venture partner at 500, mostly based in Hong Kong with a focus on blockchain investments. From a 500 perspective, we've been lucky in the sense we started blockchain investments back in 2014 with Chang.com, and in the current year, I agree, it has been a crazy year, 17 and also 18. As of today, I believe token investments have already surpassed the entire 2017. But at the same time, we spent earlier this year mostly focused on a lot of the protocol infrastructure levels, because as many of you are aware, if you looked at the performance of the blockchain, most people always mention, I love the figure, everybody always mention Visa doing a couple thousand transactions normally up to a peak of maybe they stress test out at 45K for Christmas times. But if you look at other players, right, Alibaba does at peak 256,000 transactions per second. And if we're talking about somewhere in the single or double digits, you get a sense of how far we are. This is almost like, it feels a little bit like when, I don't know if any of you remember back in 1980s, when Motorola first came out with the phone. It looks like a brick, it's cost $3,000, but it was a breakthrough. And we just have to be patient in terms of looking at when will we get to the point where there's a good enough scalability project or a good enough scale to actually enable some of the use case for adoption.
Mm-hmm. Yeah, Jordan?
I'm Jordan Clifford. I'm a co-founder of Scalar Capital. We're a crypto asset management firm. Prior to that, I was a software engineer at Coinbase for about 2 years. I've studied computer science and economics, so that gives me a bit of a background in kind of the finance as well as the software and technology. So that puts me in a good position to kind of evaluate this space. Well, I think we are definitely in a cool-off phase. There's no doubt about it. I think things got way ahead of themselves in 2017. The idea that you could just sprinkle on blockchain and you'd have a 10x valuation bump clearly is not sustainable. I think like we got quite ahead of ourselves. But I do think that long-term, I'm obviously very bullish. I think that if I had to guess, we're kind of right just before creating the Netscape in this space. Like, it's still really difficult for people to use this stuff. There's still a lot of confusion about what makes these assets valuable, what makes them, less valuable. As far as valuations, there's so much manipulation and concentration of these assets that I don't know if I would trust all the market caps. I think that there's still some hot air in some of them, and there's definitely some assets that are looking quite attractive at their relative valuations. So we're in a bit of a no man's land right now, but I think that a few more years of clarity from the regulators, financialization of this asset class, all the financial products that are coming to market here in the US, but also abroad, are going to really bring a lot of capital to this space. And the developer side of things is picking up, and it's really never been more exciting as far as the amount of talent that's coming into this space. So I think we just have to be patient, give it another 3 to 5 years, and then we'll be in a better place and in a good trajectory, hopefully.
Great. Ethan?
Great. Hi, everyone. My name is Ethan Beard. I look a little different than everybody else on the panel. I work at Ripple, and I lead an initiative called Spring. And really with Spring, we're focused on the broader XRP ecosystem. So Ripple, as a company, focused on the Internet of Value, helping money move as easily as data. Our core business being helping banks move money, mainly cross-border. We've got great momentum there. At the same time, we think XRP Ledger has a lot of use cases above and beyond what's going on in the banking world. And so Spring, we're really looking to actually identify, amplify, and help those projects take off and get off the board. So from an investing is probably just one tool that we use when we're looking out and trying to work with companies. I think, I'll echo a lot of what the panel said. I would just say we're still at very early days with blockchain. In many ways, I think I've been in technology for decades, I guess, a long time. And a lot of what I feel is each piece of technology was kind of building on previous ones, right? So we had the internet, and then I'll just start there. And then we had things like browsers, and then you actually had applications being built on top of those. And we had companies that come along like Google and Facebook. And in many ways, I think blockchain is a little different in that we're going kind of back down into the infrastructure level. We're really building new building blocks for the internet. And so I think we're still very early there, and I think it's going to take a while before we actually get more towards the application layer. So I would say we're in the first inning. I also think a couple of things, like a lot of the kind of froth that we've seen over the past few years. Arguably, of all the big token offerings for the past few years, almost none of those projects have launched, right? Filecoin, which was one of the earliest, still doesn't have a product live for anybody to use. And so, which is kind of interesting. I also think, given the crazy valuations that we saw, having done a lot of investing and been around in the Valley for a long time, one of the classic problems with startups is that they raise too much money and they just utterly fail. Like, I remember I had friends that did Color. I don't know if anybody remembers Color.
Color, yeah.
Yeah, what, $45 million or something they raised? And literally, I don't know if they ever launched a product. Lots of money is actually really bad for a really small team, because restrictions actually create creativity, I think. And so when you have a lot of money, you don't really have a whole lot of restrictions. And so I would expect that a lot of these projects that raised giant piles of money in token offerings are struggling to actually build what they said they were going to build, and they're really rich, so they don't have to build anything if they don't want to build it. So I expect we're going to see a lot of those actually blow up sometime over the course of the next year.
Yeah, definitely. Yeah, and I did want to might as well jump into that. In terms of traditional venture, you have terms, lockups, vesting, various things on the term sheet. Are any of those kinds of terms coming in for crypto startups in terms of whether they're token or equity companies?
So I think 2017 was very different. Everybody rushed into ICOs, and there was almost no governance, no lockup, etc. It was, for a lot of people, also quickly in, quickly out. I think what we're seeing now is there's a bunch of teams that realize perhaps it makes sense, to stay private longer, right, and not have a public token price associated to your platform all the time.
SAFT or private sale or something.
Yeah, or even equity that has a conversion mechanism to token when it launches. I think the second thing they see is like perhaps retail investors are not the best partners at the early stages, and sometimes it makes a lot of sense to have somebody that is more patient, long-term oriented around the table that helps with advice and building the company. So I think it is not, none of these look like traditional venture deals in many aspects, but I think they certainly have moved back from the completely free float, token, no governance, no contract, in and out mentality to something that looks a little bit more like a traditional venture deal.
Is there standardization and that types of things happening? Anyone can jump in. But.
Well, I think one of the things we've seen is the kind of the growing pains that the teams are going through so quickly, though in a very compact period of time of, say, 9 to 12 months. Is in the beginning, I think everybody was super excited, especially from a team's perspective. Oh my goodness, I got $20 million in 60 seconds, done. They, you know, if you picture them, they almost feel like they were at the top of the mountains, and then that's it. But then doesn't matter, right? Because I come from Hong Kong where we're very focused on finance. So coming from that world of IPOs, et cetera, we keep harping on the teams on one thing is, do you understand the work is not done? You are, the one big thing now, many of the teams we see are starting to be a lot more thoughtful on is post-ICO or post-token raising work on the finance that's raised, right? Because
what they do with it?
Unlike traditional VC, when we invest at our stage, early seed with a couple $100,000, all the teams have to worry about is dealing with us, right, getting our check. But once the check is in the bank, it's a very simple process. They calculate what their burn rate is. They know how long the runway is. But when we see these teams, we said, do you understand that you are actually having to manage it like a treasury? Because your input and output are in two different currencies. Right. Majority of them are, if you look at it, right, it's revenue coming in a crypto format. But I would say most of the teams, they're getting paid in fiat. So in a sense, none of the teams in the beginning have really thought about it until, you know, when we hit Q1 and Q2 of this year. Right. And they can see how quickly, if they don't manage it well, not only does it impact the expansion plans for the teams, right? But it also actually impacts a lot of the team emotion because everyone's looking at the price all the time.
Right. Yeah, it was Ethan was at Facebook, so he probably can speak to that. That was with any company that went public. But I did want to touch on the treasury management question. Is like, when do companies, assuming they raise an ETH, like when do they sell? Do they sell? Is there a process for selling? Those kinds of questions, which seems like the more that a company raises, the bigger question it is. But do you guys want to jump in on any of this? The terms?
Yeah, back to the terms. I think that like it's really important to evaluate all the parties involved in a deal and look at their incentives and look at you know alignment within those interests and those incentives. Like if somebody gets, you know, we all have the proverbial developer on the beach sipping on a Mai Tai who raised just $24 million in 60 seconds. Like that is a real problem, and the fact that investors haven't really been as careful, more so this year, but last year they were definitely not very careful with making sure that the team had skin in the game and the team had a reason to work on this project. Because when you invest in tokens, you don't have investor rights. It's not equity. You don't have investor protections. You're basically donating money to these people and hoping that the tokens they build will have utility that will, you know, people in the future will need. And that's a really big question mark, and I think that question mark has been kind of lingering in the air all year long. But I think we are getting smarter about making sure that there is skin in the game, there are milestones, and the compensation for the team is tied to actual delivering value, whereas not just putting the cart before the horse and giving them huge amounts of money and whatever you get, you get. Like that's, I think that was a big problem, and I'm glad to see that a lot of that's been corrected this year.
Yeah, generally at Ripple, we've stayed away from token offerings kind of on all sides. I think the regulatory hangover is probably the piece that we've been most sensitive of. So while it's actually technically possible to issue a token on the XRP ledger, it's something we've never really pushed for. If anything, we've kind of discouraged it due to securities issues. It turns out that may not have been an issue, but it seemed like the smart thing to do at the time. So we haven't bought any of them. As an investor, so prior to being at Ripple, I was angel investing on my own. I never bought any tokens that didn't have equity alongside of them. For me, I think the challenge I always had is that the pricing of tokens, yes, you may get them at a discount. That's kind of the greater fool theory a little bit, that somebody else is going to pay more. But the so along comes a startup and says like, okay, this token I'm going to sell to you for $1. You have to assume they get the pricing of that token right, and it's based off of absolutely nothing. It's literally just like, here's the price and here's how much money we have. And so like there may be a business that actually like makes the token have utility and worth some value, but like the fair value for it may be 10 cents or maybe $100, but like it's completely arbitrary how many tokens they're issuing and how much they're worth. And so it always seemed to me to be a pretty risky investment.
Yeah, I mean, and given that, how do you assess risk or assess sort of value or sort of potential returns for your own investors or for yourself when you look at these deals, especially compared to a traditional venture deal? Well, I mean, everything's risky to some extent, but token economics, you described it, seems like it's even more pulling it out of thin air than a traditional venture deal. So does that change how you invest in these type of deals versus when you looked at a SaaS company or something like that? Just curious do you have a different approach?
Well, one of the things coming from a traditional VC perspective is that we do realize we have to learn a new skill set, because when we looked at it, right, early in VC investing, it's complicated but also simple in a way, is that you write that check, and the only next thing you can do a couple months down the road is to decide, do I double down or do I do nothing? But once liquidity comes into play, we start to realize that you are becoming a hybrid between somewhere of a VC and a hedge fund and a secondary market PE, that potentially, if I loved working 24 hours a day, I could always look at the portfolio and try to rebalance all the time and assess the teams nonstop. But sensibly, what it gives us, the additional tools, is that, number one, 3 months down the road, as more we learned about the team and the execution power, we actually now, as an investor, have the ability, if it's liquid on an exchange, right, to pull out or actually double down anytime we want. So for us, from a traditional VC perspective, that additional option to us is an added value, right? It's a way to minimize our risk. So hence, in some form, a part of that increased valuation, we do see that it comes with that added liquidity that we now have. And also, I think the teams have to realize, I think they love the fact that, we're going to be liquid. But I said, one thing you have to realize, right? If your investors don't like you in 3 months, nobody would be invested in you anymore. And when you call our phone numbers, we're not going to be picking up.
Right. And there's different types of funds here, right? You're a traditional venture fund, whereas Jordan's, I believe, is a hedge fund, right? So it's different liquidity or redemption types of issues. Yeah,
I mean, when we look at these deals, we still think about them as venture deals, as in we're going to invest for the long term, 7 to 10 years. And, there's the option of getting liquidity earlier, but that's not kind of the initial approach when we do the investment. I think what is very interesting to think through in these deals is, it feels like the upside per deal is larger. There will be fewer winners because we're talking about global markets or marketplaces that are driven by very strong network effects. So it feels like overall we're going to see, if they work out, bigger winners.
Fewer bigger winners.
Fewer but bigger winners. That's at least our assumption right now. I think that the second question is then is the underlying token actually accruing value? And I think that's a very open question. We had a bunch of theories why a token would accrue value. A lot of people have used the store value thesis, but it's unlikely that every single token going to have that. Governance token and kind of the governance thesis is a strong one right now, but it's not quite clear how that's going to work. So it might well be that a bunch of these things never accrue any value, even though the underlying protocol is super valuable, is being used a lot. But it's going to be a transaction token that people trade in and out when they need it, like an API call, but they're not going to hold it. They're not going to, for governance purposes or for storage purposes, right? And then even if the token it has a clear value appreciation mechanism, it might not be that you're actually invested in the right entity. You might have done a company investment, but all of the value accrues in a token, or vice versa, right? And so there's still a lot to be figured out.
So there's a lot of ways to lose as well as ways to win bigger. It sounds like.
Yeah, I think it's that optionality right now is, and the potential swings in both directions are much bigger than in kind of more mature markets like the internet and mobile.
Mm-hmm. Yeah. On that point, I mean, you talked about, I'll just give one example for the issue of users controlling their data, which in blockchain, a lot of startups have talked about. You'll control your data. The big company won't control the data in a central place. You can take that data wherever you want. And several startups are working on that type of idea. But I think that's just an example of more generally that seems like there's a lot of different places that the value of a startup in this space can accrue, like whether it's with the developers, whether it's with the token holders, the equity, the investors. So it just seems like you said, there's a lot of different places where the value will accrue in the company, or if it is a company. Do you go through those different options and look at where the investors can best benefit, or how to best benefit? How do you think about that?
I think you have to. I think the reality is also that in 2017, nobody asked these hard questions. Everybody was, when you look at kind of how the different coins and underlying tokens evolved in the public markets, they evolved pretty in parallel ways, right? Nobody had a thesis why token 1 should be better than token 2. It was kind of, the markets were all going up. I think 2018 has been for the first time where people really pushing on what is actually the investment thesis around why this token should accrue value or not. And I don't think we have any of the answers. I think there's for the first time we have people pushing for different theories and probing theories, but I don't think there's any clear answer out there how this going to play out.
Mm-hmm. One of the things we observed, though, the difference in terms of when the teams send us their either decks or white papers in the last 9 months is that the maturity. In the beginning, I think we see a lot of super excited founders, rah, it's going to be data democratization, it's going to be everything. But the moment you ask about the details, right, I said, do you understand that there is no privacy? How are you expected to analyze the data? Even though, yes, you own it, great, but at some point, the value comes from analyzing the data. But at the moment, things like full homomorphic encryptions or secure multi-party computation is all in theory. And none of the teams in the beginning would have any answers. But recently, I'm starting to hear more thoughtful process about what solutions that they're proposing, right? Take an example. One of the most recent decks I get from Taiwan is actually on a supply chain solution. And I asked, same thing, right? Do you understand? It's one thing about being able to collect those data, but how are you going to process it without actually having access to the underlying data? And they actually had a very concrete answer. They said, yes, we are able to, and we have tested out partial homomorphic. And for supply chain, most of the data, we have actually noticed that 80% of it is just multiplication and addition. And in that way, we are actually able to execute it. So I said, it is an evolution of the answering and also how the teams are actually now looking at very specific issues and problems they're solving with within reasonable reach, right? Not something that's out there when every PhD you talk to, they're like, there is no way this will come into play at least 3, 4, 5 years.
Mm-hmm. I did have a question about venture as an industry, since that's one of the topics here today. For traditional venture firms, especially the larger ones, what's the outcome here? What's the sort of, what do you see them doing in terms of blockchain and crypto? It seems like you've seen a bunch of partners leave to start their own firms, or Andreessen started a separate crypto fund, which can do, they buy liquid tokens, and they do a lot of things that maybe Jordan's fund can do. Can the traditional firms do this kind of investing? Do they need to hire 10 people to do it, or is it just better to just invest in one of their partners who leaves, or what do you see happening with traditional firms?
I think traditional firms are, very intent to kind of stay in the world of companies. They understand companies deliver product, and the product needs to find a market. And maybe the blockchain is tangentially related, but I don't think that traditional firms are really as well situated to evaluate the distributed systems, the consensus protocols, the deep nuts and bolts of like how these networks are actually supposed to work and function. So for them, either hiring in-house or investing in one of their partners that leaves and starts their own thing makes a lot of sense. But it is kind of very different types of investing when you're talking about building in companies that are supplying services to this industry versus betting on teams that are building these networks. I think that that's quite a bit more specialized.
Yeah, I mean, I would also say, somebody explained it this way, to me at least, is it's very hard to minor in blockchain. You kind of have to major in it. I'm sure any of you who've tried to just dabble and say like, oh, I'm going to spend this month and learn about blockchain. A month later, you're just completely confused. At least this is how I find myself all the time. It's pretty complicated. It's not like moving, photos and text and audio across the internet connection. Just the fundamental way in which they're designed, the underlying technology, as you say, like consensus mechanisms, protocols, blockchains, what does distributed mean? I mean, you go to a blockchain conference and you can spend days talking about like, what does it mean to be distributed? Like, is it distributed enough? And there's still plenty of new projects that are looking at consensus mechanisms. And this is just like one little tiny piece of a really complicated ecosystem. And so I think I would expect that when it comes to venture investing, either having a partner who's just like all in and majoring on blockchain is a requirement, or having a fund who's just very, very much focused on it is important.
I think the counterpoint would be there's a lot of things that are similar between venture investing, traditional venture investing, and kind of crypto investing, and building large platforms over a longer period of time in partnership with an entrepreneur is at the core of both of them, right? So. I think what the biggest challenge is just for very large funds is it's usually the younger partners that are excited about crypto, and these older partners that don't necessarily buy into kind of switching their mindset to a new business model, to a new technology. And I think a lot of these younger partners just get frustrated and leave and join crypto native funds. So I think it's completely possible. I think there's actually a lot of synergies between one way and the other of investing. The challenge is in big partnerships, there might not be the incentives or the willingness to pivot or kind of change into a new direction. That's probably much more human failure than to change and adjust to something new than necessarily inability to do so.
And I think the other part is also looking down the road, right? It's always looking at long term. Correct. At the moment, we're looking at, hey, it's the next wave of Web 3.0. We're rebuilding some of the infrastructure, so enriching the current internet infrastructure with additional capabilities that blockchain can bring. Potentially, how can it be an innate payment system within the internet itself, right? Exchange of values. But at the same time, at the end of the day, we live in a human world, right? Adoption comes with understanding. And at the moment, I think, sadly, we see kind of a dichotomy. On one side, in the investing world, a lot of us are very excited, and we looked at it as, hey, we spend a lot of time studying it. And as someone mentioned earlier, is that it is a very challenging area. I told Jordan, I said, at times, I often feel like drowning still. Because every time a new aspect of the blockchain or a new consensus method comes out, you feel like you're going back to the drawing board to study that area again. But at the same time, on the corporate side, even though in the last year, I'm sure you guys have seen, right? Every single article out there, everybody's doing blockchain. But if you strip down to it, unfortunately, majority of them are nothing but a glorified SQL database, maybe with a sprinkle of cryptography on it.
It's like a private chain or
exactly.
something.
And if the corporate keeps going down that route, it's very hard for them to understand how to use this new tool. And I think that's something that we looked at and say, hey, as a venture capital firm, how can we as an investor help the projects we invest in get through that channel and actually allow more and wider industries to understand what are the capabilities at this point in time? Because at the end of the day, once they're done with the infrastructure, adoption doesn't come just automatically.
We do have questions. If you have another question, you can type it into the app here. But before we get into that, just one more question I just want to ask is about for startups that you look at that do have a token. How do you think about governance of the token itself versus if there is a company? Those kinds of questions. how do you think about that? Is there any standardization on how people manage the tokens and who controls it and those kinds of things?
I think, being an early stage investor, I think our governance mechanisms in traditional venture deals are not that powerful anyway. So I think what we always look for is alignment between founders and investors and feel like we have the same philosophy how to build a company. And then, you don't even have to look at anything that is written, right? I think it's as you go, later and people invest more money and, kind of governance becomes much more important around board seats and certain rights. And that's certainly harder to reconcile with a token investment. I think on the early stage side, I think it's not that different than kind of having an aligned vision and philosophy with founders and trusting that everybody's doing the right thing, which not always works out, but in most of the cases, if you have the right filter, actually does.
Mm-hmm.
Yeah, I think it's interesting. I mean, I feel like, and we talked a little bit about this, one of the more interesting deals that we've seen is the Andreessen Horowitz investing in Maker, where they actually bought governance tokens.
Yeah.
So it's a token that's used to govern their protocol and how the system works.
Yeah.
And there was a couple of parts of the deal I thought were interesting. One, they basically bought the tokens at half price, straight from the company.
Huge discount.
Right, so it's like a secondary deal, kind of.
Yeah.
At the same time, those tokens are liquid, so like arguably, depending on liquidity of the market, it's not that liquid, but like they could actually start offloading them. I think it was a 1-year lockup on some piece of them. Yeah. So it's kind of, I don't think they were buying them for governance reasons. I think they were buying them for alignment with the founders. Like they like the team. I don't know. I've never spoken to them, but like I think the project's super interesting. So I can see how they would like the team, like the project. You can't really buy equity in it because it's this weird organization. But what's the best way to align yourself with the founders? Well, the founders are all sitting on this same token, and it's liquid. And so I would think that what I think is interesting with Andreessen is like they've just been willing to be super flexible in how they approach investing. And I think that's actually probably the key because it's just not obvious. Like, do you buy equity? Do you buy tokens? Do you buy pre-sales? Do you buy secondary liquid tokens? And I think the answer is yes. And you need to, and I think a lot of traditional firms for a while struggled to actually just, a lot of times their LP agreements wouldn't even let them do these sorts of deals. And so I think that's starting to change, but I think that flexibility is going to continue to be important.
Yeah, that's a good example of how different it is. It's a liquid trading token that they invested in at a discount. But they're not getting a board seat, or I don't know if there is a board, but so that is really interesting. So we have some questions. I'm just going to read off some of them, and you guys can just jump in, I guess, on whichever ones you're interested in. What are your favorite picks with inspiring or innovative applications of blockchain? And I'll just add, if there are certain sectors that you're particularly interested in also. And the next one is, what do you look for in teams for blockchain startups, and how different is that from traditional venture? Sounds like, Boris, you said it was similar, but do you guys want to jump in on any of those?
So I think what we get excited about is kind of finance 2.0, rebuilding of the financial system, and we've seen tons of innovation in that space. Starting with X and kind of everything that's built on top of that protocol. Mm-hmm. I think that's going to continue. And we see more and more sophisticated financial instruments in that space. I think the second category we're super interested in is crypto collectibles. That started with CryptoKitties, but I think we're still at the whole trend of
You did that, right?
Yes, we invest in CryptoKitties, and we think that there's more to that whole notion of crypto collectibles, and we're excited about that space.
Mm-hmm. And for us, one of the things I tend to be more on the practical side, and sometimes always looking at, what is the simplest question we're asking. And to me, the only thing that blockchain really solves, and is the best hammer for the nail, is for any problem that involves non-trusting parties that have to transact things of value, anything of value, right? It can be data, it can be currencies. If we go along that line, one of the industries obviously is banking, because a lot of any transactions in banking requires a trust. But in specific areas, right, things like trade financing, where it involves a lot of geographically dispersed parties that are traditionally far apart and hard for them to establish a relationship with each other. The second areas we're very interested in and start to look at the practicality of adoption is in the gaming industry. What I mean is that the gaming ecosystem, we see the players are most accustomed to an ecosystem that is actually alike the current cryptocurrency ecosystem in terms of incentives driven. And also you looked at the items that they're looking at, right? One of the companies we invest in called Cocos, they're actually a traditionally large open source game development platform. And the way they looked at blockchain is it gives them an additional tool for them to actually enable, potentially in the future, cross-game exchange of items, skins, collectibles. Whereas a lot of the times what we see is a natural extension of enriching the gamer's experience within a game, because we know that traditionally the game life cycles are quite short. Right. So from game to game to game, a lot of the times we see that that's a natural extension. So for us, it's always looking at kind of the natural, where's the low-hanging fruits, who are going to be most adopted to using this technology.
So after spending thousands of dollars on your game, at least you could transfer that to the next one that comes along. Jordan?
Yeah, so I think that Boris is right on hit the nail on the head. I think, and along with Bonnie, finance is really what's interesting here. The ability for the internet to have an overlay that allows value transfer, value storage, and that transmission without intermediaries and without trusting in counterparties, that is still what gets why this whole industry is really interesting. The enterprise, the data, the healthcare, blockchain stuff, that's all marginal in my view, at least for now. I think that really the more interesting part is the ability to build a more inclusive financial system for everybody in the world to participate. So that, and then privacy is, I guess, my add-on to that. I think that the idea of having all of everybody's affairs in public view is not going to be tenable for lots of people, most people maybe. So I think privacy is a sector that is really important to watch.
Right. Ethan, you look at, I think you know a little bit about the financial side of this.
It's interesting, and I swear, I actually just met two of these panelists for the first time just off stage, so we actually didn't have any conversation, but we're in remarkable agreement. I think blockchain is really good for money. Like just kind of full stop. Like it's exactly that. It's like when you need to trustlessly transact and exchange value, and like value almost always comes down to money. Like if it's not worth money, it's not valuable. So we think like blockchain's really great for money generally, and that's what we're focused on at Ripple. I'm also very interested in kind of the next generation of financial products. So things that look like futures, forwards, derivatives, debt. And can they be created in a trustless manner without counterparty risk? And it sounds like feel like we're getting pretty close to some of these, so we're really, really excited about that. We're also at Ripple really interested in interoperability. We think that there's going to be lots and lots of blockchains in the future, and we don't think people are going to be carrying thousands of wallets and have to go to some specific exchange and buy some specific token and come back to some specific project and spend it there. I think like there's going to be a layer of interoperability. We are focused on one called Interledger Protocol, but we think there's lots of opportunities there. And then gaming, I'm a huge believer in as well. But we saw this at Facebook, like the early adopters from the developer standpoint were the game developers, and they just understand how to like pick apart a platform. They've also been operating virtual economies inside of games for a decade or so. So they actually understand the economics of kind of supply, demand, money supply more than most people.
Can I just add one quick comment?
Yeah.
As much as we love the fact that blockchain enables us to transact with people we don't trust, just one thing, it's a great thing to have trust. So don't try to use blockchain on everything, because I think at the end of the day, our world is great to have some trust in it.
I think that's a good note to end on. Great. Well, thanks to all the panelists. This has been great.
Thank you.